There are problems in depending on your job for a salary income. You are at the mercy of your boss's whims. You face constant job insecurity and lack freedom of time. What is an alternative to monthly salary tied to full-time employment? Before we delve into dividend investing for constant income stream even while you sleep, some facts on dividend paying stocks. This is the list of dividend paying stocks. Vedanta boasting a dividend yield of 29%. 1 lakh investment last year would have earned you a solid 29,000 rupees in dividend. Hindustan Zinc with a 19% dividend yield translates to a 19,000 rupees income on a 1 lakh investment. However, there's a catch. Investing 1 lakh in Vedanta at the wrong time could have resulted in a staggering loss of 70% or 45%. So while your initial investment earned you 29,000 rupees, your capital is lost and now worth only rupees 30,000 or 55,000. Think of it as investing in a local finance company. They pay you interest for a year, but when it's time to withdraw your capital, they don't return it. So we encounter two distinct categories. One side, there are high dividend paying companies whose stock prices may remain stagnant or even decline, making those seemingly high dividends unreal. Conversely, the other category comprises companies offering modest dividends in the range of 2% to 3%, but compensating with stock price appreciation. As an example, Tech Mahindra has given an 80% stock price increase along with a dividend yield of 2.24%. Rupees 1 lakh invested 5 years ago is worth 1,80,000 today. Along with that, it has given a dividend of 2,240 rupees every year. This is only for an understanding of the concept because the dividend payout can vary from year to year. Similarly, Redington has a dividend yield of 4% and the stock price is appreciated by 319%. So one has to look at both capital appreciation and a nominal dividend yield. This investment style comes with its share of catch. Companies offering high dividends often fall into one of the three categories. Cyclical businesses that are susceptible to economic downturn and share price loss, those under government ownership, and entities with questionable promoters. The latter might prioritize hefty dividend payments so that they can pay themselves. However, the share price can be very volatile, causing capital erosion for retail investors. If you look at the stocks in the ICICI Dividend Yield Fund, just as an example, the stocks include ICICI Bank, NTPC, Sun Pharma, Maruti Suzuki, HDFC Bank, Airtel, etc. The dividend yield of NTPC is about 2%. For rest of the stocks in the top holding, you will find that the dividend yields 1% or even lesser. Does that make the stock or the portfolio bad? Not necessarily. The fund's portfolio of stocks have delivered a return of 39% in the past 1 year, compared to 28% of the Nifty. Over the past approximate 10 years, the fund has delivered 15% annualized return versus 12% of the Nifty. A decrease in dividend yield doesn't necessarily indicate a bad stock. If the stock price has gone up, then it's a good investment. High dividend yields may not be sustainable for the long term. Investors therefore should focus on companies maintaining consistent payouts rather than high payouts. Dividend yield can also act as a cushion against share price fall. For example, if HCL's dividend yield is 3%, and the stock becomes any more cheaper, the dividend yield increases. This potentially prevents further stock price decline. For those investors who need to know what stocks to invest in for dividend investing, the Nifty Dividend Opportunities 50 Index provides 50 dividend yielding stocks that also meet other investable criteria. These are the 50 companies in this portfolio, and the top 10 by weightages are these stocks. The dividend yield of this portfolio is 3%, which means 1 lakh invested would have yielded 3,000 per year. Not enough, you would say. But it has also given capital appreciation of approximately 14% annually, which means 1 lakh invested has grown by 14,000 and then at this rate every year since inception. The stock in this portfolio are rebalanced once a year. An investor therefore looking for dividend income should look at harvesting. Invest a corpus and after a year of investing, look at what profits have been generated as capital gains and dividends and withdraw the same as income. Repeat this process annually. The concept of a yearly cycle serves a dual purpose, minimizing capital gains tax while affording ample time for the fund to showcase its performance. Due to inherent volatility of equity markets, certain years may witness low or negative profits. During such periods, refraining from withdrawal is advised, enabling additional time for compounding. As time progresses, these withdrawals smooth out, potentially creating a sustainable second income stream. Scrutinizing the dividend policy of company therefore becomes crucial. A good company management which does not need additional capital to run the business, as in the case of say services companies, may pay back shareholders through dividends rather than keeping the money with themselves. In summary, for dividend investing, one must look for stock price appreciation in conjunction with dividends payout. Companies pay dividends when they are not able to reinvest profits in their own business in a profitable manner. Payments of dividend does not necessarily indicate that a company is good or bad. It's just economics of the business that mandates it. If a company is profitable, growing fast, and need more cash, then the profits are better reinvested rather than dividends being paid out. This can result in stock price appreciation. You can run a screener with this rule: dividend yield greater than 3% and return on capital employed greater than 20%. You get an output of 34 stocks which you can use as your research universe to check if the stock prices have appreciated. Are these businesses cyclicals or secular growers, etc.? If you like the content of this video, please press the like button and subscribe to this channel. Please consider sharing it with your friends who may be looking for a second income.